Welcome to today's seminar. R.C. Thornton and Associates sponsors a webinar by the Durfee Law Group, and it's Tax Strategies for Charitable Giving. If you have any questions throughout this seminar, please email them to chuck@rcthornton.com. I think everyone on this call knows Chuck Thornton of R.C. Thornton and Associates CPAs. Chuck works extensively in the tax area. He is an author, lecturer, and frequent guest webinar presenter. The firm's mission is to help clients achieve financial success, and that means saving taxes. He works with numerous consultants like our speaker today. By doing so, he brings in specialty and expertise in certain areas needed for effective tax planning. Chuck's background includes being a CPA, personal financial specialist, charter life underwriter, and certified financial planner. He is a graduate of New York University with a master's in taxation. Don't hold this against him, but he did work for the IRS a long time ago. He is also owner of R.C. Thornton Financial Solutions, LLC, another CPA entity specializing in investment planning. Today, Chuck is the moderator of our presentation. So Chuck, would you please introduce our speaker?
I certainly will, and thank you there, Kit. I appreciate the introduction and talking about working with people over the years. Rick and I go way back. It's almost we don't even know how far back it goes, but Rick is an attorney that I've worked with in the past with mutual clients. He's one of the preeminent attorneys, as far as I'm concerned, in the country and has a great rating with Martindale-Hubbell rating. He speaks at a bunch of industry and consumer conferences all across the country, talking about dynasty estate planning with families and advisors. The thing that appeals to me a lot with Rick is not only is he very astute in the estate planning, but I like the fact that he not only deals with what's called donor advised funds, which we're going to learn what that is here shortly. He's actually created one, and I've actually utilized it myself for some fundraising activities. And we're probably going to get some interesting questions then that we'll be able to ask him. So without further ado, Rick, why don't I introduce you? Rick Durfee.
Chuck, thank you. I was thinking about how long we've worked together, and it's been long enough that you and I are now the old guys, and the people that were the old guys when we started are gone. So we've been doing this a while. It's fun to have this chat about charitable planning and donor advised funds. I'm here today kind of in two capacities. I make my living as a lawyer through Durfee Law Group, and I volunteer as an unpaid volunteer with Legacy Global Foundation. We're going to talk quite a bit about them. And I guess I kind of want to start with a story. Oh, I have to first give the disclosure. I am a lawyer. The disclosure here proves it. And anything I say today cannot be used to lie, cheat, or steal from the IRS. And if you try it, they'll nail you. And nothing I say today can be used as a defense. So just don't go there. With this kind of charitable planning that we're going to be talking about today, this is part of a bigger picture. The family dynasty includes multiple structures, trusts, business entities, and the family foundation is a crucial component of that. And it's actually out of that Legacy Global Foundation grew. Early on, several decades ago, actually, I did some planning for some high net worth people and had some sad experiences with some charitable partners where they promised one thing and didn't do it. And it was out of that frustration that Legacy Global Foundation kind of grew, and its kind of byline has been delivering the promise that inspires the charitable gift. People do charitable planning for reasons, and we want to actually make those happen. And so that's a critical thing here. When we do dynasty planning, we're going to hold assets in trusts, and they facilitate moving assets from one generation to the next. We're going to segregate control from liability. We segregate assets from control. That's what that family office and family bank do there. With the family foundation, that's where we have what many people call social capital. That's where we have funds or resources that we're going to take and bless the world and make the world a better place. And That's where we implement our values. And then on the slide, you can see that that's where we capture money that we're otherwise going to send to the politicians. And instead of letting the politicians decide what's going to happen with it, it's better if we can do that within the context of our families. And this whole dynasty idea, that's the notion that wealth doesn't have to be a single generation or even just this current generation and the next one that we can see. Wealth can actually be something that grows from one generation to the next and continues to bless and strengthen the family. And the family foundation is a crucial part of that, and we're going to talk about why. Now, when you go to form a foundation, there's lots of choices. A foundation can be formed as a trust. It can be formed as a corporate entity. There's a few states now that'll even allow it to be structured as a limited liability company. For many, many decades, the default was an association. And the new kid on the block is the fourth one you see there in the entity type, which is a component fund. And that's where you piggyback on to another organization that's already done all the hard part of the setup and the compliance, and they allow you to have a fund within their organization as a component, so it's part of their organization, and then you get the same tax attributes as the parent organization that you're working with, and that's really significant. And most people understand intuitively nonprofit. What does that mean? That means an organization that doesn't make profit, and that's not really what it means. Actually, nonprofit means technically tax exempt, so they can make money and they don't have to pay taxes. And there are several varieties of nonprofit organizations. The default one is what is known as a private foundation, and private foundations, the most famous one today, and actually the largest one on the earth at the moment, is the Bill and Melinda Gates Foundation with billions and billions of dollars. Private foundations have been popular for a long time, but they are expensive. It's hard to set up and takes some doing, so unless you have a certain amount of money, it's just not worth it. Public charities are the schools and the churches and the hospitals, things that are supported generally by the public, and there's several tests to get there. And then support organizations are kind of a hybrid, something that comes in the middle. They're a separate corporate entity, again, either a corporate LLC or a corporation or a trust or an association, but they are affiliated with a public charity and therefore get that public charity status. And there's big differences between these. We're going to look at this here in just a minute. So the point with a donor advised fund as your family foundation is that you can create this. You can create it fairly easily. When you put money in, you get a tax deduction. It can build up inside of this family foundation as an endowment, so a permanent fund that grows and grows and grows. You get to use your outside money managers. You're not locked into limited things if you do it right. And then you get to make grants out of your foundation to charities that you select. And the reason why I like the donor advised fund and we like Legacy Global Foundation in particular is it costs less and you get better tax treatment. And I want to unpack this and look at the specifics. With a private foundation, so we're going to contrast a private foundation to a donor advised fund. If you're going to go set up a private foundation, you're Bill and Melinda Gates, or you've got that kind of money, you can do that. And right off the bat, there are excise taxes on portfolio earnings inside of a private foundation. And with a donor advised fund, you don't have that tax. With a private foundation, you are compelled by law to give away 5% of your assets every year, with the goal that ultimately the private foundation is going to end. It's going to shut down because all of its assets will be gone. And with the donor advised fund, you don't have that requirement. So you can grow it and build it over time. With a private foundation, when you make a contribution, you do get a deduction, but you can only apply that deduction to up to 30% of your adjusted gross income on an annual basis. With the donor advised fund, you get to apply that same deduction to up to 60% of your adjusted gross income. And in both instances, you can roll the unused portion of your deduction forward up to 5 years, but you get to use more of it faster with the donor advised fund. the cost of setting up the private foundation is significant. It's significant enough that my counsel is, and I've set up plenty of these, unless you're going to fund it or capitalize it with at least $10 million, it's probably not worth it. The cost benefit just won't be there. With the donor advised fund, the cost is very low and in fact can be zero. With a private foundation, you have to do a tax return every year and all of the accounting that goes along with that. With the donor advised fund, you don't. The sponsoring organization takes care of all of that for you. With the private foundation, on the one hand, as you see on the bottom of the list there, you get to sign your own checks, but then your compliance officer that you have to get approval on for all of your activities is the IRS. With a donor advised fund, you don't get to sign your own checks, but your compliance officer is an independent board of directors, and that board of directors generally wants to say yes, and is going to say yes to anything that's not against the law. Their primary function is to make sure that we don't do anything naughty or that's illegal or that would support something like terrorists or politicians, and sometimes there's a fine line between the two, but the board makes sure that we don't do anything that would cause the organization to lose its tax-exempt status, but generally they are in favor of supporting charities recommended by the donor. And then, of course, private foundations, you can hire employees. So you can have a staff, you can have your children or other people work for the foundation under certain circumstances. With the donor advised fund, no employees. So your kids are not going to work for it. You're not going to have a payroll. And again, you don't get to sign the funds with the checks with the donor advised fund, what you do with the private foundation. So for an operating charity, like if you're going to have a soup kitchen or a used clothing store or an orphanage or a pet shelter or something where you are actually functioning as a charity, a donor advised fund won't work. But if your primary function is to give money to charities that you believe in and want to support, the donor advised fund is hands down the best option. And let me just say, the numbers tell us something. It's been a few years ago now. The number of donor advised funds now exceed the number of private foundations. And there are aggressive marketing schemes by donor advised funds to convert private foundations into donor advised funds because they simply cost less and they work better. And that little power versus control, you really have the illusion of control. You don't really have control with a private foundation. The illusion comes because, oh, I'm an employee and I get a paycheck and I get to sign the check. But really, the IRS has to approve everything you do. And if they don't like it, they'll spank you and shut you down. With the donor advised fund, you don't have to mess with that, but you have the power in terms of deciding what charities get supported or don't get supported. So that's kind of the breakdown, some technical things on the differences between donor advised funds and private foundations. So with the donor advised fund on my slide, here's a little mislabeled. It's supposed to be the private foundation versus the donor advised fund. The donor advised fund, you outsource the compliance. That's the nasty stuff that nobody wants to do. Who wants to do tax returns? Who wants to do accounting? And you get to do the cool part, the fun part, the enjoyable thing, which is selecting the charities and saying, ooh, this is what I want to support. And then a big, huge thing with donor advised funds, people ask all the time, well, why don't I just give money directly to the charity that I've selected instead of going through a donor advised fund? And that's a fair question. And sometimes the answer is, nah, don't use the donor advised fund, just give it to your charity. That's right. But here, especially when you're building a long-term endowment and you're going to have something that lasts a long time, the donor advised fund gives you the capacity to hold your charities accountable to your values, so that if your charity gets derailed or hijacked or somehow gets off track and is no longer supporting or implementing the charitable values and causes that you believe in, with a donor advised fund, you can say, you know what, we're going to go find another organization that does support what we're doing. The donor advised fund, of course, works really well with all the other planning, and we showed you several examples of that in the beginning. But with your dynasty trusts and your business entities, it can be branded for private label charitable funding. So if you have a retail store, for example, and you want to do roundup contributions, would you like to round up your receipt here at the cash register and give the 27 cents to our company foundation? You can do that with your donor advice fund. It's kind of cool. Let me comment on the future generation and grooming aspect of a donor advice funds. I work with families that have lots of money, and I get to watch what the wealth does to those families over time. And wealth is a catalyst. It's a powerful thing that triggers a reaction in the family. And one of the things it triggers is whatever you are, it will make you more of that. If you're an honest, decent, good person, it will make you more honest, better, and even more decent. If you're a corrupt, conniving, wicked person, it will make you worse. And families that have a long-term, healthy, positive relationship with wealth have a culture of charitable giving in their family. And the donor advice fund plays a key role in that. So this has a huge impact. If you're thinking, wow, me or my clients or whoever I'm working with, we're concerned about what our wealth is going to do to our family, we don't want to mess them up, then a donor advice fund becomes a key part of the planning because it can be used to help prepare that generation. And we've talked about the tax recovery device here. You can send it to the politicians or you can choose what's going to happen with it, your choice. And then the planned giving tool, that's kind of an advanced concept we'll touch on a little bit here as we go. When you go to set up a donor advice fund, there are lots of companies that offer donor advice funds solutions. There are financial service providers, there are specific charities and causes, there are local things that are geographically based, and I kind of want to go down through each of these. The captive financial, the three largest donor advice funds are all run by financial institutions, and I'm not going to say who they are, but what do they want out of the deal? What they want, candidly, is money under management. They want to have billions and billions of dollars that they control, that they get to invest. When you go with a financial captive, you are locked in. You are going to invest on their platform with their financial products. And some of these, and again, I'm not going to say any names, but it's been my observation that some of them will quote a low fee. Oh, look, we charge a low fee. And what they don't show you is that there are other costs that they end up charging you, and they're making money on the arbitrage between what they credit to your donor advice fund in terms of return on investment and what they're making on the back end of those very same investments. But if you're locked in, if you know I use this particular financial platform and I just want to use them and that's what I prefer, great, you can go for that. And I have clients that on occasion do that. But there's something better than the captive financial. The other is captive geographic. This is your local community foundation, and there's 26, 27 of these throughout the country. That is the local fill-in-the-blank community foundation. And what they're after is supporting charities in that place, in that location. And if you say, great, I want to set up my donor advice fund there, you can. But when you say, well, I want to make a gift to a charity that's somewhere else on the planet, outside of that community, often they won't let you, or they're very reluctant to. They will try and discourage that and will steer you back. No, give it here in our community. And what I found is that my clients don't stay in the same place forever. And even if they do, their children don't. They spread out. They end up being involved in more than one community and more than one place. So again, while the captive geographic donor advice provider has its place, it's not optimal. Then there's the captive cause. So every brand name church has a donor advice fund. Most colleges do, a lot of hospitals do. And if you go to them, if you go to your brand name institution, whatever that is, and set up a donor advice fund with them, they will let you support any charitable cause that you want to within their scope of operation, whatever they're doing. Often churches will say, yes, you can give to any one of our missions that you want. Or the school will say, yes, you can support any of our colleges or any of our programs that you want. So if you want to be narrowly confined like that, if that's your goal, if that satisfies your concerns, maybe that's going to be good for you. But if you want to do more than that, it's not going to work. So then there's the independent. And Legacy Global is one of these, which is why I like them. But independent means they're not stuck on any financial captive, any financial platform. You can work on any financial platform anywhere in the world using any lawful currency, any lawful investment. It means your grants, the charities that you support are not locked into any one location. You can support any charity anywhere in the world that's a lawful charity. And same with causes. If it's a lawful cause, you can support it. Now, I've got their pseudo versus actual. There's some organizations that claim to be independent, but on the back end, there will be something that's not independent. All of their funds are invested in a certain financial platform, and you have to go there. Or they will only allow it to go to one generation. They'll allow it to go to your children, but not your grandchildren. So you need to look at that. And again, I like Legacy, and I've been involved in Legacy from its founding, partly because it went completely independent on all these platforms. You can invest in any platform using your financial advisors, give anywhere in the world, support any lawful cause, and it can go for as long as you want it to in your family. So that's kind of the difference. So if you're down there and you're saying, okay, well, yeah, I kind of like this idea of the donor advice fund. How do I set it up? What do I do? How's it going to tie into things? And when you form the donor advice fund, we look at what's happening in the greater context. So we want to help you identify what is your charitable mission. And let me just add here, if you don't have genuine, bona fide, actual charitable intent, if you're just doing this because you think you get some tax benefit, it's probably not your thing. It's probably not what you want to do. You really need to have actual charitable intent. I've had the experience of having somebody put a lot of money into a donor advice fund because they get the tax benefit, and then sometime later saying, hey, I want to unwind that. How do I get that money back? And the answer is, you don't. You gave it away. It's now charitable. You must use it for charitable purposes. So in that universe, in that context, we're going to set up this donor advice fund. Often these are done in conjunction with split interest gifts, so a charitable remainder trust or charitable gift annuity, or you can get tax advantaged income, where you can avoid capital gains on the sale of highly appreciated assets. That's part of the tax planning that we want to look at in the universe, the context that we're setting this up. Very often, a donor advised fund is a powerful tool as part of an asset protection plan. Money that you've given away to charity isn't yours and can't be taken away from you. And we can even help you preserve the income interest in that. And we've talked about next generation planning already. Let me comment on the leadership issue here. In fact, there's some of my slides that have talks I do around the country. I talk about the money pyramid. There's people who want money, and there's fewer people who actually get it, and even fewer yet who are able to keep it once they get it, and fewer yet are able to pass it to their children once they keep it, and fewer yet are able to pass it to their children and not mess up their children. It takes leadership to be able to build wealth and keep wealth and transfer it to the next generation and have that be a good thing and not a bad thing. So the donor advice fund is a key tool and part of, again, the big picture that we're looking at. How does this fit into what you're doing with your family? And we've again already addressed the charitable accountability things. So when you go to set up the donor advice fund, you fill out an application. It's relatively simple. There's 1 or 2 pages that are essential. There's a whole lot of supplemental pages that are not necessary, but that you can change anytime. So you can have a donor advice fund set up in just a few seconds by filling out the 1 page and signing it. I know Legacy has an online form. You can click on their website, click, and have it set up in a matter of seconds, literally. You can designate who's going to be the advisors. Here's my money manager. Here's my CPA firm. Here's my law firm. Here's my brother-in-law or my cousin or my sister or whoever's going to work with you on that. You can define your charitable mission. Here's the kinds of things I want to support and the kinds of things I don't want to support. You can set up, you can make contributions. Initially, you can set up how contributions are going to be made. And Chuck, you and I were talking before we started here. A cool thing that Legacy lets you do is you can put they give you the code, a snippet of code that you can put on your personal website, so you can go out and convince your family and friends to contribute to your family foundation and support that and help support the cause. Then we have to do the account setup. So if you're going to work with an outside money manager and you're going to have money in this donor advised fund, Legacy will set up an account with that money manager that's segregated, and will have your funds that you've put in there in your donor advised fund and then get invested in keeping with your investment policies and goals. So you and Legacy and your financial advisor will talk together. How soon are you needing the money? Are you going to give it all away next year, or are you building it up? Are you just giving away the income, or do you have a shorter life expectancy for how long you're going to use these funds? You set up those policies and goals, and then you get to watch how those things are invested. You then recommend, okay, here's my charities that I want to support. I want to give money to this charity and that charity, and it can be in this dollar amount or in this percentage. If you're building it as an endowment, one of my favorite things is the Nobel Prize model. Every year, the Nobel Prize awards go up. And the reason they go up is because they have a corpus principal that's invested, and they only give away a fraction of their income. The rest of their income they contribute to the principal, so the principal grows every year, so it makes it possible for those charitable grants that come out of that foundation to get bigger every year. So we can do the same thing with your donor advised fund. We've already talked about accountability. Let me tell you about delivering versus sending the money. You can have the funds go to the charities of your choice in a variety of ways. They can go anonymously, and we have a lot of donors that's what they prefer. We can have the check sent to them with acknowledgement that this comes from the generosity of you. Or the check could even be sent to you. Here you go, here's the check payable to your favorite charity, and you can then take that check and deliver it to them. And we have a number of donors that do that and really enjoy that. And of course, then you get periodic statements that show you the activity, the growth in investments, and the distributions that have been made and so forth. Wow, I didn't expect to get to the end of this so fast, Chuck. I've been talking faster than I expected. But hopefully, as you've listened to this, you've thought of something that maybe you ought to do in your own planning. Would a donor advised fund make sense for you? Would potentially a split interest gift make sense for you? And if you've thought of any of those things, or maybe you have other estate planning going on, again, you can call Legacy directly, or there's their website here on this slide. You can talk to me at my law firm. There's my website. And in both of those places, there's a lot of articles and videos and things that explain this. So, Chuck, I've been kind of talking full speed ahead here. Are there comments or questions?
You know, Rick, thanks so much. That was a fantastic presentation. You know, I wanted to just take a potential live case that Rick and I have been talking about to show you how this could really be beneficial. And the case goes something like this. Individual has a variety of real estate. He owns a business. He intends on one day selling his business, intends on living off the rental income. And then when he is done and he passes away, and his wife passes away, he would like the real estate now to go to charity, which presumably would sell the real estate probably to the person who bought the business or to someone who would collect the rents. So issue number one is, under the current estate tax rules, which means you can have an estate up to $20 million, is leaving a gift to charity after you pass away have any tax advantages to it? What do you think,
Well,
Rick?
yeah, it totally does. And estate tax planning is only one of the reasons to do estate planning in general and charitable planning in particular. There are and should be many non-tax reasons, not the least of which is the one I mentioned at the beginning, that you need some charitable intent. If you don't actually want to or believe in supporting charities, then don't do any of this. But if supporting a charity is part of your game plan, then yeah. And kind of to build on that, particularly for situations where people either don't have children or they've already provided, quote unquote, enough for their children, and they don't need to give them any more, then they can time when the tax benefits of a charitable gift are going to happen. Are they going to happen after you're dead, or are they going to happen while you're alive? Now, some things are better when you're dead. Some things are better when you're alive. In my opinion, tax deductions are better while you're living. So we can structure those tax deductions on a gift that isn't actually completed in terms of the charity getting the money. The charity doesn't actually get the money until you're dead, but you can get the tax deductions while you're alive, and you can retain a lifetime right to the income that flows off of those assets, like the real estate you used. So in that example, we would use the split interest gift, and there's two varieties of that, the trust or the annuity, but the bottom line is you split the future residue at death from the present income, and you keep the income interest and give away the remainder when you're dead. And when you do that, you can take highly appreciated assets and liquidate them, sell them with zero capital gains tax. The entire proceeds of sale without any deductions for paying taxes get invested, feed you an income for the rest of your life, and you get a tax deduction today, and then when you pass away, the money pours into your donor advised fund, into your family foundation, and supports the charities that you've designated. So what do you get? You get reduced taxes today. You avoid the capital gains. You get a tax deduction. You get a tax-advantaged income for the rest of your life. You support your charitable causes. And if in that mix you say, well, wait, I want the $1 million of the property, whatever it was, to ultimately go to my children, we have some planning things you can do for that as well. So you get to have your cake and eat it too on multiple fronts. You get the benefits of the charitable giving while retaining control over and income from the property. So it's kind of cool.
Very good. On the setting up the donor advised fund, one person writes in, you said this could be multi-generational, but once I, the donor, pass away, how is it handled of the next person who's going to be the advisor to the fund?
Oh, that's great. Great question. With legacy, at least, you can designate. You can say, here's who I want to be in charge. I want my children and my descendants in perpetuity. I want the trustees of my trust or the board of directors for my company, or I want this child and not that child. So you can be very specific and designate that. I know that other donor advised funds, some don't let you go beyond you at all. Some will let you go to your children, but not beyond that. Legacy has no limits. As long as there's a lawfully recognized person that you've designated, they can stand in your shoes and do what you did as the donor in terms of recommending charities and setting policies and for investment and selecting how the funds are going to be applied for charitable use.
This is an issue that you and I were working on. We just talked about a situation where someone may have rental, they want the rental income, they maybe will donate to donor advised funds that'll be sold later on. But let's take the situation where someone has a variety of real estate to make it really easy. Let's just say it's raw land, not to get into operations of business and stuff. And obviously, if they sell the property and then they turn around and donate it to the fund, they're going to have a tax and a deduction. The better result would be is to donate the property directly to the fund and then have the fund sell it. So now we got a step further. So someone has a series of properties they want to do this with. Once they donate, let's say I donate these parcels of land to you, you're going to have to sell them. Is there some aspect of the donor needing to follow up with you on how to actually sell the properties?
Yeah, great question. So let me paraphrase what I hear in your question. Timing is everything. If you sell the property first and make the gift after the sale, what has happened is you have incurred a taxable liability. You've had a taxable event, and then you get a tax deduction after the fact, so your tax benefit is going to be limited. But if you gift the property prior to the tax event, you avoid the tax event, and then you get the tax benefit and the avoided tax event. So there's more bang for the buck on doing that. But you're right. If you do that, then the donor advised fund has to participate in selling the assets. So let me give you a couple of scenarios. I had a client situation some years ago where the donor had an asset they were selling, and they gifted it to the donor advised fund with the intent of it going to charity when they sold it. and it went on the market, but it didn't sell. And what the donor advised fund did is it declined the gift. It said, hey, we couldn't sell this. We don't want it. Take it back. So the gift didn't happen in that year. In the next year, the donor said, well, I'll gift it again, and did paperwork to gift it. Once again, it went on the market for sale. Once again, it did not sell, and the donor advised fund said, we don't want this. Take it back. So they declined the gift. And it was, I think, in the third year when finally it was gifted and it sold. And once again, the taxable event was avoided, and the tax benefit of the contribution was gained, and the proceeds of sale then went to the family foundation. So there is some coordination. I had another situation where a client sold a business for tens of millions of dollars and wanted to tithe to his church, and he put in a big chunk of the business before the sale, got a tax deduction for it. Then the donor advised fund, the family foundation, was actually one of the sellers on that business and signed the documents and participated in the sale. But the tax benefits to that individual were millions and millions of dollars. So the timing is everything on that. And that's another thing. One of Legacy Global Foundation's niches is they will work with that kind of deal. And they have experience and some creativity. Most donor advised funds will say, no, sell your stuff and give us the cash when you're done with it. Don't bother us with that hairy stuff in between. And Legacy will say, we'll work with you. We'll work with your legal team and your accounting team and your financial team, and we'll help come up with a solution that will meet your concerns.
That's one of the reasons I think working with you, Rick, is kind of unique. Some of these topics I've just tossed out, you can never go to a financial institution, donor advised fund to do these type of things, and some of the other donor advised funds, although they're not institutionals, would not even understand some of these concepts. So it's quite a connection if you have an estate type situation, tax situation that can help amplify the benefits using a place like Legacy. Now, something a little simpler. I think I heard you say someone could do something to round up their expenditures and have the difference go to the donor foundation. Did I hear you say that, or did I just imagine that?
Absolutely. So let's say your business, whatever it is, and you have people making a point of purchase decisions. They're standing at the cash register with their basket full of goodies, and they're paying you for them, and there's whatever 27 cents of change. Your employee can say, would you like to round up and contribute that to the My Business Foundation? And so we can white label that, so it's labeled. You get the branding. Your business gets the goodwill in the community of giving to charity, and you can say our My Business Foundation, whatever that is, supports this and this and this charity, and then you get that 27 cents. And if you do that all day long with every customer that comes through the door, just saying, you end up raising a lot of money. And then I have a client, for example, who does this. And every year, one of the employee benefits that they give is they give their employees a charitable budget. They'll say, we'll give you, X number of dollars. You can recommend the charities. And then the employees go out and say, well, wow, I want to support my local Boy Scout troop or school or hospital or whatever. And so it really ends up, the charitable dollars end up going into the community to causes that people are connected with, and that means something to the people involved, which is, in my opinion, far more powerful than sending it off to some nameless, faceless institution, and we don't really know what they did with it. Here, the whole company and all of their employees know what happened with the money, and they all had a voice in it, and so it becomes more connected and more meaningful.
Very good. Now, I think probably one of my Boy Scout people, adult leaders, are listening in because they sent in an email and they basically said, could you just walk us through how we could use this in a Boy Scout troop? And by the way, this question could be Girl Scouts, it could be any other group, but it just happens to be a question about how a Boy Scout troop could use the donor advised funds.
Sure, and we've actually had this happen, and it's really fun. So we would have one of the leaders of the troop, their scoutmaster, their committee chair, or whoever, and again, whatever that organization happens to be, would come in and do the paperwork to set up the fund, and it could be the XYZ Scout Troop 1, 2, 3, 4, whatever it is, fund, and then they can capitalize it. You know, they can put money in it. They can have their little link on their website for their Scout Troop and go to all the grandparents and aunts and uncles and brothers and sisters and neighbors and friends and say, hey, support our Scout Troop, go right here. And we've even had people say, okay, we're doing a car wash, and the car wash is free, but we would like you to make a contribution to our troop fund here that's tax deductible. And so people right there with their iPad standing in the parking lot while the hose is running on their car can say, yeah, I'll give your organization $20 or $50 or $100. And so there's some cool stuff that you can do with that to raise money for Scout troops or Girl Scout troops or schools or whatever. We've actually worked with a lot of, I'll give you another example, school clubs that come under school sponsorship, and they're school organizations, so they qualify as actually a public charity because they're part of the educational institute. So if you're running a science club, we had one that raised a pretty sizable amount of money, tens of thousands of dollars, to build a robot for engineering students, and they did fundraisers and went to family members and said, hey, we're trying to buy all this equipment, and it's going to be, you know, it's ultimately going to go through the school, so it's a school sponsored thing. And that's, I need to point out, with all those kinds of things, there are compliance things that you have to do to make sure that you're not stepping across the line and getting in trouble with the IRS. And one of the things that legacy staff is really great at is, how do we structure this so that we're acting inside the rules so we're not going to get in trouble? And sometimes people, not for malicious reasons, but just because they don't know what the rules are, they want to do this or that. And no, we can't do it that way because that's not allowed, but we can do it this way because this is allowed. Legacy staff can help guide and structure that so that it works.
Very good. One last question, and this is actually coming from me. Let's say a Boy Scout troop did want to do this. They want grandmas and grandpas and stuff to donate. You say there's this link. I assume, does that take you to some credit card mechanism where someone can, because obviously if they're going to do this on the internet, there needs to be some credit card, a way to take the money. Is that something you have set up?
Yeah, Legacy has that set up, yes. And it gets flagged because each fund has a unique link, or there's a tag or something. I frankly don't know the ins and outs of the technicality of it, but I know that each fund, so if it's your Scout troop or your school with that link, and somebody clicks on it and says, yeah, I'm gonna give $20, it gets tagged and it goes right to your fund, and the receipts are automated. They get a receipt. Thank you for your generous contribution. Here's your tax receipt for tax purposes, and the money comes in. And I have to add, it comes in net of fees. The credit card companies charge a fee for that, so whatever that fee is, and it ranges depending on the card you're using. So you'll get dinged your little fee on the credit card usage, but it's really a great way to raise money.
That's great. Well, I think we're getting to the end of our time, but what's really impressive here for anyone listening to this is that, you know, we have a tendency as accountants and attorneys that deal in the estate work to think of we'll donate land, or we'll do this, we'll take an annuity back. And these are certainly some fantastic ideas. But what really is appealing to me, in addition to that, is the fact that you could bring this down to your local business, rounding up you're talking about, Boy Scout troops, use of credit card. There are so many uses of this, and if you try to imagine, you can never organize this on your own for any efficient amount to make this happen. So, Rick, you've been doing this a long time, and you have taken Legacy Global all sorts of different fantastic directions. I appreciate very much you spending time with us and sharing some of your expertise. I would encourage people, if you're interested in these topics, to give Rick a call. And I think now, Kit, I'm going to turn it back over to you.
All right, great. Hey, thank you so much, Chuck and Rick, for your informative presentation today and all the questions. And if you want to see any other webinars, just check out our website, www.rcthornton.com. Thank you so much and have a great day.